Welcome to the Daily Business and Finance Show. Unpacking Biden's grocery price focus amid FTC's Albertsons, Kroger deal, LNG export freeze sparks emissions and security concerns, the Showdown, Magnificent 7 versus Tech Bubble 5, Super Bowl 58 ad drama, Bud revives patriarchy, GM steps back, global debt soars as stocks bonds dynamics shift, Tesla expands retail footprint to South America with Chile store launch, China's mysterious market stabilization strategy unveiled, and Barron's misses the megacap boat in 2023. Stay tuned after this short ad break for a deep dive into these headlines. President Biden is urging grocery retailers to reduce their prices, focusing on those companies that are keeping high profit margins. This action coincides with the Federal Trade Commission's consideration of Kroger's proposed acquisition of Albertsons for $25 billion. Critics suggest this merger could lead to an increase in consumer prices. Despite opposition from different sectors, Kroger maintains that the merger would lead to substantial price cuts at Albertsons stores.
EQT Corporation's chief executive officer, Toby Rice, has voiced criticism towards the Biden administration's decision to halt new licenses for exporting liquefied natural gas, or LNG. He views this move as a political stunt that could potentially escalate emissions and jeopardize global energy security. In addition, ExxonMobil's chief financial officer, Kathy Michaels, labels this decision as a mistake that obstructs the path to achieving net zero goals. On another note, 10 Democrat lawmakers are urging President Biden to reconsider his stance on this issue. Despite the ongoing controversy surrounding this matter, Jean-Ju Lee from the Wall Street Journal proposes that a natural deceleration in the construction of LNG facilities was likely on the horizon regardless.
Goldman Sachs has put forward a suggestion that the Magnificent 7 tech stocks, which include Apple, Amazon, Alphabet, Meta, Microsoft, Nvidia, and Tesla, could persist in outperforming. Even though they are trading at a price-to-earnings multiple that is higher than the rest of the market's average, their robust fundamentals and an anticipated revenue growth of 12% per year until 2026 might fuel future returns. However, Goldman advises investors to tread carefully as growth estimates within this group show significant variation.
Budweiser is reintroducing its renowned Clydesdales for the Super Bowl this year, transitioning back to themes with a more masculine appeal. Despite the hefty price tag attached to game-time advertising, numerous consumer goods corporations are capitalizing on the chance to engage a broad audience. In contrast, Detroit's trio of major car manufacturers are opting out this year due to unpredictability in the electric vehicle market's expansion. Concurrently, Lionel Messi is set for his inaugural Super Bowl appearance representing Michelob Ultra, while other brands hint at thrilling unveilings during their commercial breaks.
Global debt has escalated to an unprecedented $224 trillion in the fourth quarter, a significant increase from $150 trillion in 2013 and a mere $75 trillion in 2003. This surge encompasses government debt, which has risen by 60% to reach $83 trillion. Corporate debt has also seen a substantial increase of 50%, amounting to $86 trillion, while household debt has grown by 40% to stand at $55 trillion. Despite these alarming figures, there is no significant decrease in the cost of capital. The conventional correlation between bonds and stocks is undergoing a transformation, suggesting the possibility of bubbles or deflation on the horizon. Investors are shifting their focus towards bubble stocks and distressed assets such as those found in China or within small-cap companies.
Tesla has inaugurated its inaugural South American outlet in Santiago, Chile, signifying a fresh trajectory for the manufacturer of electric vehicles. Even though the regional adoption of EVs is low and Tesla's high prices may restrict market penetration, this step is in harmony with Chile's ambitious objective to retail exclusively electric vehicles by the year 2035.
Regulators in China are assuring to bring stability to the faltering stock market, although no concrete plans have been disclosed as of now. The market is experiencing a record sixth month of consecutive losses, and the CSI 300 index has hit a 5-year low. There are discussions about a potential stabilization fund for stocks worth $278 billion. In other news, former President Trump is contemplating imposing tariffs exceeding 60% on imports from China.
In the year 2023, Barron's recommended selection of 77 stocks did not meet expectations, yielding an average return of only 9.9%, falling short when compared to their benchmark's return of 12.7%. The standout performer was Tesla, with a staggering return close to 120%. Other notable performers were Frontier Communications and Ferguson. On the flip side, Hertz and Pfizer were among those that underperformed significantly. The performance evaluation of this portfolio is done in comparison with indices such as the S&P 500, S&P Midcap 400 or Russell 2000.
And that's a wrap on today's The Daily Business and Finance Show. Stay informed, stay invested. Until next time, keep making those smart business moves. I'm Montgomery Jones.
And I'm Amalia Dupre. Goodbye for now, until we meet again tomorrow. This content is sourced from the Seeking Alpha website, so support our podcast by becoming a Seeking Alpha Premium subscriber. See the show notes page for links to sign up. This episode is produced by Classic Studios. This podcast provides information only and should not be construed as financial or business advice. Check out our other podcasts in our network at classicstudios.com.